Hello, this is Carole Foos with OJM Group. I'd like to thank you for joining our webcast. We're going to talk today about surviving in the new tax environment. My role at OJM is as the Director of Tax Planning. I'm a CPA, have been in practice in public accounting for 25 years. So we're going to speak to you today about the new tax law that went into effect January 1st, 2013, and give you some thoughts on planning ideas that you might want to implement for 2013 as well as 2014. OJM Group is a registered investment advisor, so we do want to show you this disclaimer. We certainly don't consider this webcast to be personalized investment advice, and any tax advice or tax thoughts that are in this should be run by your personal tax advisor before implementing anything. We'd also like to offer you free materials for participating in the webcast. As you can see on the screen, there are several books that have been written by the principals of the firm. At the end of the presentation, we will show you how to contact us to get a free copy of those books sent to you. So our topics for today include adapting to the new tax environment, the new Medicare tax and the new Affordable Care surtax, new limitations on itemized deductions and exemptions, and planning ideas that will include corporate structure, investment income, retirement income, and estate planning. So the new tax environment that we're in, unfortunately, is an environment that has increased rates on high-income taxpayers. It's increased rates, it's added some new taxes, and it's limited deductions for those high-income taxpayers. Really, these are the biggest changes we've seen in tax law in more than 10 years. Most of these changes were effective as of January 1st, 2013. So you're going to feel the pinch of those changes when you file your 2013 income tax returns for both business and individuals. What we're talking about particularly is the American Taxpayer Relief Act of 2012. That was signed into law at the beginning of January of this year and added a new top marginal tax bracket of 39.6%. It also increased capital gain and dividend tax rates for taxpayers that are affected by that new marginal bracket. And that new bracket, as well as the increased capital gain and qualified dividend tax rates, apply to taxpayers with taxable income over $400,000 for single taxpayers and over $450,000 for taxpayers who are married and file joint tax returns. There's also a new Medicare tax on investment income. That applies to adjusted gross income over $200,000 for single taxpayers and over $250,000 for married taxpayers. Now, this tax actually came into play under the Affordable Care Act as a means of funding the new health care initiatives that President Obama signed into law. That act also provided for a new Medicare tax on wages. That tax will apply to all earned income over $200,000 for single taxpayers and over $250,000 for married taxpayers. So it's going to apply not only to wages but also to self-employment income for those taxpayers. There are also new estate and gift tax rules that were passed last year in January, as well as new deductions and phase-outs on or phase-outs of deductions for itemized deductions and exemptions. Those new phase-outs apply to taxpayers with adjusted gross income over $250,000 if you're single, $275,000 for heads of household, and $300,000 for married taxpayers. So again, a lot of different numbers that we're throwing out there. The new higher tax rates apply to taxable income of $400,000 or $450,000. The new taxes on your investments will apply if your adjusted gross income is over $200,000 or $250,000. And those new limitations on itemized deductions and exemptions will apply at $250,000 to $300,000, depending on your filing status. So that new income tax bracket that was added, the 39.6% bracket, is an increase of 4.6 percentage points over the previous highest individual tax rate. If you recall, last year in 2012, that highest individual tax rate was 35%. It's now gone up to 39.6%. So while it's a 4.6 percentage increase, it's actually a 13.14% increase in the amount you're paying. It also essentially eliminates that 35% bracket for single taxpayers. There's a very narrow window of single taxpayers, only those with taxable income from $398,351 to $400,000 will now be in that 35% tax bracket. In addition to that, because of the impact of reduced itemized deductions and the potential loss of personal exemptions, even if you weren't at $450,000 of taxable income last year, you may very well be in that bracket this year because you've lost the ability to deduct some of your expenses. So one thing that's very timely for you to consider right now is talking to your CPA about what your estimated taxes will be for 2013, thinking about whether you have paid enough in estimated taxes or had enough withheld. If you haven't, consider increasing your withholding for those paychecks you will still be getting the remainder of the year in order to avoid any underpayment penalties. So taxpayers in that new bracket, as I mentioned, will also be subject to increased long-term capital gains and qualifying dividend rates of 20%. That's up from the highest maximum previously of 15%. In addition, the Affordable Care Act has added a 3.8% surtax onto net investment income, which will include long-term capital gains and qualified dividends. Therefore, the top tax rate for those items of income has gone from 15% in 2012 to 23.8% in 2013. That really translates into an effective increase of 58.6%. It does make planning for investment income more necessary than it's been in a long time. So another new increase is the 0.9% increase in the hospital insurance tax on earned income. You know, your earned income currently, if you earn your income via salary and receive wages, or perhaps you're self-employed, you're going to pay FICA and Medicare tax. So Social Security and Medicare tax, in other words. Currently, if you're an employee, you pay 1.45% on your income, on your Medicare tax on your income, and your employer pays another 1.45%. Your portion, the employee portion, will now be taxed at 2.35% if you're above those thresholds that we talked about. So $200,000 for single taxpayers or $250,000 for married taxpayers. Your employer tax will not be increased, but it does make that total combined employee and employer tax at 3.8%. It also does apply to self-employment income and takes the self-employment tax to 3.8% as well. That's in addition to the Social Security portion of the tax. There's also a 3.8% surtax on the lesser of net investment income or the excess of modified adjusted gross income over certain thresholds. Those thresholds, again, are $200,000 for single taxpayers or $250,000 for married taxpayers. So that's going to apply to all net investment income, which will include your interest income, all of your dividend income. That's both the qualified dividends that are subject to the lower tax rates and non-qualified dividends, which are subject to normal ordinary income tax rates. It will apply to any rental income you have, royalties, capital gains, as we just mentioned, and also any income from passive activities. So if you are an investor in a flow-through activity, such as an S corporation or a partnership, and your income from that activity is passive income, it will now be taxed at the ordinary income tax rates plus a 3.8% surtax if you're above those thresholds and this tax applies to you. As I mentioned, itemized deductions and exemptions are being limited beginning in 2013. This is a reinstatement. The Bush tax cuts that were in effect previously had taken this limitation away. It's now back to where it was before the Bush tax cuts. The itemized deduction limitations reduces your itemized deductions by 3% of the amount your adjusted gross income exceeds a threshold. The most that your itemized deductions may be reduced is 80% of your total itemized deductions. Now, this reduction in itemized deductions will not apply to medical expenses, investment interest, or casualty and theft losses, but it will apply to things like your mortgage interest, your charitable contributions. So again, for certain taxpayers, that can be a big additional increase in your federal income tax. There is also a phase out of personal exemptions. The personal exemption amount for 2013 is $3,900. If you recall, you receive a personal exemption for yourself, your spouse, and each of your dependents. This phase out will cut the exemption by 2% for every $2,500 of income that you have over those threshold amounts. Again, for this limitation, the threshold amounts are $250,000 for single taxpayers and $300,000 for married taxpayers. Essentially, what will happen is if you are a single taxpayer with more than $372,500 of adjusted gross income, or a married taxpayer with over $422,500 of adjusted gross income, you will no longer get a single dollar of personal exemptions on your tax return as a deduction. So let's talk about some ideas and things that you might do as tax planning to help reduce the impact of some of these new taxes and increased taxes that we're facing. First of all, one of the keys that you should look at is your corporate structure. Corporate structure is very important. Having the right corporate structure to make sure you're maximizing tax benefits is one of the greatest tax plays that you can make. An active owner of an S corporation can avoid both the Medicare tax and that net investment income surtax on non-salary distributions. You know, you do have to pay reasonable compensation as an owner of an S Corp to yourself for services that you provide to your corporation. But above that reasonable compensation, any profits that you take out of the company will not be subject to the Medicare tax. In addition, because that income is not passive income, it's also not going to be subject to the 3.8% surtax. So take a look at your corporate structure. Are you maximizing those S corporation profits if you're organized as an S Corp while still paying yourself a reasonable salary? This is going to be very important. In addition, limited partners who are considered active may also avoid both self-employment tax and the surtax on net investment income. So a limited partnership might be a good corporate structure for you. And certainly C corporations are becoming more popular again, both because of their lower top tax rates. Top tax rate for a C corporation currently is 35%, as opposed to that 39.6% individual tax rate. Also, C corporations may offer you many more options in benefit planning that you don't have as a greater than 2% owner of an S corporation or as a partner in a partnership. And one of the things that we certainly like to talk to our clients about and that we think can be the best tax planning is a multi-entity structure. A multi-entity structure where you have your main business structured in one way and maybe another division of that business structured another way can offer the best tax planning opportunities, as it may allow you to take advantage of the different aspects of various corporate entities. I also want to talk to you today about some planning that you may want to do with your investment income. Again, investment income is going to be subject to that additional 3.8% surtax if you're above the threshold. So it's very important from a tax standpoint to have that investment income managed in a tax-efficient manner. One of the things you want to look at is tax diversification of your investments. Certain investment will be taxed at ordinary income tax rates, 39.6% plus the 3.8% surtax. Others will be taxed at qualified dividends and capital gains rates, which may be 23.8%. And certainly investments that are tax-free are a great benefit in these days of high income tax rates. So thinking about some tax-favored investments, such as oil and gas partnerships, municipal bonds, deferred annuities, or cash value life insurance will become more important now that the rates are higher on investment income. One thing you might want to consider and speak with your investment advisor about is, should you be investing for growth rather than income? If your investments are currently earning income that you're reinvesting, maybe part of your portfolio should be moved to a growth portfolio. Again, this is something you should speak to your individual investment advisor about. Identify specifically the shares of stock that you're selling for capital gains and losses. If you've been buying a lot of stock over the years in a certain company, obviously your basis in those shares is going to be very different, maybe from the time you started buying the shares to the most recent shares purchased. So specific identification of those shares can greatly impact your capital gains and losses. Another thing to think about is offsetting short-term gains and losses with long-term gains and losses. Short-term capital gains are taxed at the highest ordinary income tax rates, while long-term gains are taxed at the lower capital gains rates. So it's definitely important, if you can, if it makes investment sense, to hold an investment for greater than 12 months in order to get those long-term rates. You also need to be aware of the wash sale rules. If you're selling an investment for a loss, maybe in order to take that loss against some other capital gain income that you have this year, you can't repurchase the investment within 30 days and still report the loss on your tax return. So make sure you talk to your CPA about those wash sale rules before you reinvest in a stock where you've had a capital loss recently. Also consider installment sales. If you're, for instance, selling your business, might make more sense to sell it on an installment sale basis so that the gain can be spread out over multiple tax years. One of the things you might want to think about on your investment income, if you own a building and that building is a self-rental. So in other words, perhaps you own an LLC that owns a building and your business rents its space from that LLC that you also own. That's a self-rental. You might want to think about grouping your rental activities in order to avoid, or grouping your activities in order to avoid the net investment income tax on that self-rental. This should be looked at and talked to with your tax advisor. Another thing you might want to do in looking at your investment income is donate appreciated stock instead of cash. If you've got capital gain or an unrealized gain on stock, instead of selling that stock, maybe donate that in lieu of donating cash to your favorite charity. This allows you to deduct the full value of the stock at the date of donation while avoiding paying capital gains tax on that appreciation. Another important area for planning will be your retirement income. Again, as rates have gone up on federal taxes, many states have also increased their rates to make up for budget shortfalls. So deferring income really is important and has become more beneficial. Take a look at your qualified retirement plan, look at what you're deferring, and consider maximizing that deferral. You also want to diversify your retirement income. While it's great to defer income right now and get the tax deduction, you also know that when you pull that money out in retirement, you're going to pay ordinary income tax on what you deferred as well as on the growth. So obviously we don't know what tax rates will be at the time you start taking your retirement plan distributions, but know that you'll pay ordinary income tax on that money. So it is important to diversify. If you have the option to contribute to a Roth 401k, you might want to contribute part of your retirement savings to a Roth. That does not give you the deduction today, but the earnings on that Roth will be tax deferred and you won't pay tax on the distributions. So that way you might have some money in a bucket that you're not going to pay tax on in retirement, other money in a traditional qualified retirement plan that you will pay tax on. It's also important to avoid early distributions of your retirement income. Distributions that you take out before you reach age 59 and a half, unless you meet a special exclusion, will be subject to a 10% penalty tax on top of the ordinary income taxes. You might also want to consider a Roth conversion. All taxpayers, regardless of income, can now convert traditional IRAs to Roth IRAs. Any income or monies in that traditional IRA which have not previously been taxed will be subject to tax at the date of conversion, but from the date of conversion on, the growth will be tax-free, and then the distributions that come out will be tax-free. So that's something to look at and run calculations to see if that makes sense to you. Hybrid benefit plans can offer great planning for retirement income. These hybrid benefit plans might allow you to take a partial deduction today for what goes into the plan, but still have the money grow in a tax-deferred basis and come out on a tax-free basis. Again, as a way to diversify your retirement income options, this can have some big tax benefits. There are also estate tax planning considerations that should be made. Consider lifetime gifts now while the exemption is at $5.25 million. You know, when the tax bill was passed last January, it made permanent the estate tax exemption. However, there have already been some proposals out to go back to a reduced estate tax exemption of $3.5 million. Some have been at $1 million. So while you've got that $5.25 million exemption, it might be a great time to consider gifts as part of your estate tax planning. You can also pass on discounted gifts to your beneficiaries. Passing on ownership in a family limited partnership to a minority owner can generally be done at a discounted value. You may want to create a dynasty trust as part of your estate planning. Also, one of the great benefits of the estate tax law as it stands now is portability. What portability means is I have a $5 million estate tax exemption, my husband has a $5 million estate tax exemption. If I die first and don't use all of my $5 million exemption, the remainder of it will pass on to my husband, so his exemption gets increased. However, it is important to know that in order to get that portability, you do have to file an estate tax return within 9 months of death. So a lot of people don't realize that. And also, don't assume that because you and your spouse right now have $10.5 million estate tax exemption, that that's always going to be the case. You shouldn't sit back and avoid doing any estate tax planning just because the exemption amount is high right now. It's very possible that that high exemption amount will not remain where it is. So one of the things I'd like to talk to you about now is who we are at OJM Group and what we do. We're a multidisciplinary financial planning firm. We do comprehensive financial planning. We manage investments, provide retirement, education, and college planning services, tax advisory services, and asset protection planning. And in addition, we do insurance planning. We do appreciate you joining our webcast today. Next steps for you, you can request a free copy of our books, or you can download a highlights edition of the book. We'd love for you to call us or email us to schedule a complimentary consultation with our principals. Certainly, you can go to our website and subscribe to our free e-newsletter that we send out monthly. And you can see on the screen our phone number and an email address to contact us at OJM. Again, thanks for joining us on the webcast. We really appreciate your time, and we hope to hear from you.